Welcome to Market Call. Thanks for joining us today. I'm Morella Fernandez. Mike Philbrick with us on the show. He's CEO at Resolve Asset Management. He's taking your questions today on exchange-traded funds. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at BNNBloomberg.ca. Thanks for coming in. Good to see you.
Pleasure.
Let's talk a little bit about GDP numbers coming in lower than some anticipated, but not completely unexpected.
No, not at all. I think quite in line with maybe what was expected. And I don't think that we should be distracted by that. I think that's going to lead to more accommodation and probably going to lead to more robust business growth down the track.
Why do you say that?
Well, when you have a situation where you've had higher interest rates, that does slow the economy. And there's a great deal of growth and opportunity coming from our neighbor to the south of us. And because we're a resource-rich nation, if we can get a little bit less carbon embarrassed and more pro-carbon and pro-resources, that leaves us in a very good spot as we go through the tidal wave of innovation that has to manifest in some sort of physical data centers, power for those data centers, AI boom, digital asset boom. All of those things that have been more software oriented are going to start to become more hardware oriented and more actual physical. We're going to go from software to steel, if you will. Mm-hmm. And so those things benefit Canada in a great way.
You mentioned if we get over our embarrassment of being resource rich, which I like the way you put it. Do you feel like that's beginning to happen now that we have a new prime minister who says he's open to energy projects?
I think it's crisis necessity change. Mm. So we are faced with a situation where, as we set up in the market commentary, there are several things going on, and this administration in the United States is taking a coordinated program to achieve those. So there's a hegemony issue. In the U.S., you used to control the currency, but with the rising debt and the rising China power, this multipolar world, that's going to fade, and people are going to want to price things. Nations are going to price things in things other than U.S. dollars. So this takes away from the U.S. dollar, but the U.S. has got a plan for that. And that is, if you can't control the currency, control the protocol. Control the commerce through digital assets and through AI. Now, what that then turns into is a physical manifestation of how do you create the power for AI, how do you create the data centers for AI, and you're seeing the deregulation in the U.S. to bring down barriers for resource development, to bring, we now have a strategic resource reserve that's been developed in the U.S. All of this is happening in a coordinated nature, and it's going to benefit Canada in a big way if we can just get out of our own way. And I think we'll be just forced to. It'll just be too economically viable for Canada to do that. And it's just going to happen. And there's going to be rhetoric and talk in government about, we're softening on it and this and that. That's kind of the story. The facts are, it has to be done. It's a very profitable thing to be done. It sets up North America as a global head of commerce, Canada with all its resources, and the U.S. with all its sort of commerce power.
Need for the resources, yeah.
And so this sets up a pretty bullish scenario.
Okay, we're going to talk some more about that in a moment. We're going to set up some phone calls for Mike Philbrick, Resolve Asset Management. He's taking your questions today on exchange-traded funds. Here's how to reach us. We're back in just a moment. Stay tuned. Welcome back. We're going to start with an email from Omar, who says, I would like your guest's opinion on the HDIV ETF, which is a Hamilton Enhanced Canadian Covered Call ETF. What's included under this umbrella?
Yeah, this is a multi-fund approach. So it's the Hamilton portfolio of their covered writing suite. So it's quite diversified, which is great. And it does add a bit of leverage. So you've got 25% leverage on this portfolio and your covered writing, and it's a series of their other funds underneath this particular one. The nice thing is they don't charge a management fee on this one. You are paying the management fee on the other underlying ETFs that they have in there. And they're writing various amounts of covered rights. So some of them write more fully, some of them write a little bit less. So the nice thing is you've got some upside potential, because whenever you're covered writing, the give up is that when you get that premium, that caps the amount that you make on the upside. The nice thing here is if our scenario is right, and that chart does look like it's right, that we should be bullish. Markets are not sold off today on this surprise in the GDP news. So it's interesting that I think this is actually a good play if you're looking for that kind of income. You're comfortable with a bit of leverage, because remember, leverage cuts both ways. Leverage, if it's downside, you get a little bit more downside. But given that we have a bullish kind of view, this is actually a pretty good broad array of covered written portfolios and with some upside. So the whole portfolio is not written. So that way you get that upside in the portion that's not, you get the income on the side that you're writing.
Got it. Okay, let's go back to another email. This one's from John. John says, any chance Mike could look at HPYT, which is the harvest, and when I pull up the chart, I have it at about $8.75 on a downward trend since, I guess, last fall. What's been happening here?
Well, it's bonds.
Yeah.
So, you've got long duration bonds in here, and what they're doing is they're doing that same covered writing strategy where they've got very long duration bonds. If interest rates go up, bonds go down. So what you're trying to do is attenuate some of that volatility with writing those calls on top of it to get that income in. But you are exposed to long duration bonds at the end of the day. It comes in a multiple of different currency offerings as well. I think it's probably okay to stick with it. The interesting thing here is when you're covered writing long duration bonds too, here's the funny thing. So you're getting some income to attenuate the volatility, but it's kind of the volatility you want. So if we do get a growth shock, or something where long-term rates kind of come down, you get a burst in performance from your long-term bonds, but you're kind of called away because you've sold the calls on top of them. So it's, this is a kind of a between product. I think, if you're in a sideways to slightly up, slightly down market, selling calls on your long bonds makes sense. If you do feel that we're going to get into a situation where long-term rates are actually going to decline, then you're giving up a lot of the upside that those bonds will give you. Just things to be aware of. Got it.
Okay, let's go to a caller then. Paul's on the line from Prince George. Hi, Paul.
Hi, thanks for taking my call. Tom Lee started a new thematic ETF last November based on two themes, AI and cybersecurity. Just want to know what your thoughts are on that, Mike.
Okay, so this is the GRNY fund strat granny shot, US large cap. Okay, so what is part of this ETF?
So a couple of things. First of all, Tom Lee is sort of becoming the GOAT these days on his predictions about the markets. He's been particularly salient, right? And so that's part of it. The granny shot's name comes from the whole idea of free throws in basketball.
The basketball
Correct.
Shot, of course.
So if you take the granny shot, you have a higher percentage chance of actually making the shot, but it doesn't look cool.
It looks ridiculous. Yes. Okay.
So that's where that name comes from. And it's more than just, I think you said AI and cyber, but it's more than that. He's looking at key demographic trends, looking at technology trends, looking at fiscal trends, monetary trends, and then he's looking to try and capture a couple of vectors of that wind for the sale so that you don't have to be right specifically on one thing, but you're looking at things in the portfolio where you might be right from a couple of different angles, demographics and AI, for example, something along those lines. I think he's got a fair bit of financials in the product right now because his thesis is that this evolution to digital structure and underlying infrastructure is going to be a huge benefactor to U.S. banks, as an example. So this Ethereum network that's running stable coins, that's going to be pervasive into U.S. banks, and it's going to make them much more efficient. Their profits are going to go up. That's some of the theses he has in this portfolio. It has outperformed. It's pretty cool and fun. So, yeah, I mean, I would go with it.
When you have ETFs that are so mixed, right? They have different sectors. They're touching on different things. It's much more complicated. How do you advise investors to look at it?
You really want to sit down and look at what Tom Lee is talking about in the actual description. right? So how he's thinking through granny shots, why he wants 2 or 3 of these vectors of change where he sees real long-term significant change, demographics and AI, or digital currency and financial services. And they're looking to capture a couple of these vectors in order to get that extra return. Not over days and weeks, right? This happens over quarters and years. And it's been great thus far. It's outperformed because of what he's looking at. But yeah, so I think in an ETF like this, it's more what's the thesis, because you're not going to get to do the thesis yourself. For example, we want cybersecurity, so we go buy a cyber ETF. That gives us direct to that theme. Tom's theme in Granny is a little bit more amorphous. It's several themes, and so it's going to move around. So you want to know the ethos of the thinking versus the actual, you're not shooting with just
each sector and why he's hitting that. Okay. Let's go to a quick break. We're going to come back with more callers and emails. We're back in a moment. Stay tuned. Welcome back. Glad to go to Wayne on the line in Moncton with a question for Mike today. Hi, Wayne.
Hi, how are you?
Good, thank you. How are you?
Good. My question is on HHIS, and why is the dividend so high, and is it sustainable? I just can't understand why this one's so high and all the other ETFs I'm in are 10 cents below.
Okay, thank you for the questions. This is Harvest Diversified High Income Shares, ETF. Is this one that you like?
I think it's actually one that's included in the first one that we went over, which is it's a diversified high income strategy from Harvest. Actually, it might have been Hamilton. Those two, I do get them mixed up on occasion. Anyway, it's the Harvest Diversified High Income Shares. So again, 1.25 on the leverage side. So leverage cuts both ways, and they do covered right the portfolio and at the money pretty extensively. So that's why the yield is there. And remember, that yield is often a return of capital. And not often at all, but some of it is a return of capital. And it does cap the upside on part of the portfolio. So that's why you're seeing that extra income in the portfolio. But I like this because it's diversified. And if our thesis is correct, broad diversified exposure to the Canadian market and what's in the portfolio with a little bit of leverage and covered writing probably works to your favor, gives you that income. But again, if we're not right, that can work the other way.
Got it. Okay, I hope that helps Wayne out. Let's go to Ken, who is on the line in Vancouver. Hi, Ken.
Hi. Putting new money to work with valuations stretched as they are, I'm a little bit worried about that, but I'm looking at healthcare sector. It's very undervalued, and I also want yield and some growth. So I'm thinking about buying HHL, a covered call healthcare ETF, and combining it with XHC, which is non-covered call. That way I get some growth and I will get some income. What's your view on all of this? Thanks.
Okay, so can I ask you just about healthcare and what where your head is on that space? It has been beaten down this year. We've seen a little bit of comeback, sort of more lately, but generally, do you see sort of a bounce back? We've talked about so many other things, but healthcare has kind of been hanging there.
Yeah, I think it's actually, as the viewer said, I'm worried about valuations. I'm trying to look for something that's a little non-correlated, that has some demographic drivers that might be a little bit different, that actually has maybe struggled rather than just going with the Magnificent Seven. So I think given that thesis, then yeah, this is an interesting way to play it. And I like the way he's thinking through the problem, which is let's own some covered written, and I've recommended this a few times when I've been on. Don't give up all the upside. Have some that's covered written in your portfolio and have some that's not, so you capture some of the upside. And it's a bit of it's not really even that downtrodden. It just hasn't participated. And it looks to me like, as we get clarity in the healthcare system in the U.S., you're going to see more and more of these things, I think, come online, profits normalize. I kind of think that the demographic trend there is pretty good. The whole Ozempic, weight loss scenario thing is playing a big role in that. So I kind of like the thesis that the caller has, something that hasn't quite ripped as much as everything else is. So I'm not chasing performance, and I'm going to do it in a balanced way. think that's a really good strategy and a good sector to do it on because it's not as economically sensitive as others.
Got it. Okay, let's move on to Olivia, who has an email, says, please suggest a Canadian fixed income ETF to provide a high non-covered call return. The one she's looking at is ZRR, which yields 4.5%.
Right, and the ZRR these are inflation protected bonds. So you get the yield plus you get a reflection of what CPI is running at. And so they're a very interesting type of bond, kind of unique. There's only two, I think there's the other one is XRP in Canada. So there's only two real return ETFs. They're best held in registered accounts because they have some funky tax that comes with them because you get this CPI tracking, which then goes into your unit, but you have to pay interest income on it. It's a bit funny. But this is really kind of what's your macroeconomic framework. And so if you expect rate cuts and softer growth, then you might want to go with the BMO Long Corporate Bond Index ETF, so ZLC,
okay,
or XLB. So we've got a corporate bond long-term bond fund, or the iShares Canadian long-term bond fund. So those are long duration assets. If we get cuts in rates, long-term rates come down 75 to 100 basis points, your yield's locked in and you get some capital return as well on those. If you're a little bit more higher income and you're willing to accept the business cycle risk, then you can go into high yield or higher corporate class yielding stuff. So there you've got the XHY, which is the iShares High Yield Bond Index, sort of U.S. high yield bonds, or the BMO High Yield U.S. Corp ETF as well, which is ZHY, and the other, that was ZHY, and the other one was XHY.
XHY. Okay.
So those are more credit oriented, so they're going to respond more to the business cycle. Credit spreads are pretty tight right now. I'm not sure that you're getting paid a ton for that, but it really depends on macroeconomic framework there.
Okay, if you were to look at for Olivia, let's go to Alan on the line from Montreal. Hi, Alan.
Hi, thank you, Mike, for taking my call. I'd like to ask your opinion on this ETF, Vanguard FTSE Canadian High Dividend Yield Index ETF, VDY, if you like it, and if not, what else can you suggest? Thank you.
Okay, so that's a Vanguard. Let's take a look at that. Before the performance of the FTSE. Got it.
Yeah.
Okay. And?
Love it.
Okay, tell me why.
I love it. So, you've got this, so that's the FTSE Canadian High Dividend Income ETF. So we're in Canada. That's great. I think to some degree, investors may be getting distracted with the U.S. and not thinking about their Canadian holdings and not thinking about their international holdings. And so what we have here is the U.S. has become largely software dominant. And if our thesis is correct that, hey, we're moving from more software to hardware, and we're more moving from, that software world where AI is going to disrupt software a bit, and we're moving into a much more harder world, and the AI is going to bleed through financial services and benefit them, and bleed through natural resources and benefit them. That's why you're seeing this outperformance. And so if you are an individual looking for dividend income and it's a Canadian part of your portfolio, this is great. 22 basis point fee, Vanguard, 400+% on your yield. You could look at XDIV, XDIV. And what XDIV is, that is the iShares Core MSCI Canadian Quality Dividend ETF. What you'll see here is a slightly lower yield, and they focus on the quality of the dividend, where Vanguard is a high yield. So if you have a high yield, they're going to put you in, and that's kind of the main headline. Quality is saying, well, let's look at your yield, but let's look at the underlying fundamentals of the business. What's the cash flow like? What's your debt like? What's your ability to grow those dividends? So you give up a little bit of income today for the hopes that by tracking the quality, you're going to have more dividend growth later. So I like VDY. It would be a lovely complement to have XDIV in the portfolio as well, because it focuses on those quality issues.
Got it. Okay, we are going to take a quick break. We will take a look at Mike's past picks when we come back. Stay tuned. Thanks for joining us on Market Call. We are going to go through Mike's past picks from October 15th, 2024. At the time, he chose Sprott Uranium Miners ETF, GRNM, 48.10 US at the time, and up to 50.49 today, a return of 5%, total return of 8%. You were ahead of the game on uranium. A lot of people started talking about that earlier this year with the data build out and all that kind of thing. But why did you choose this in October, and do you still like it now?
Yeah. Early is wrong, I guess. So I was early and there was a drawdown, so there was a better place to buy it, but I was seeing what everybody else is becoming more clear on now, which was the fact that if you're going to have this build out that we're talking about, and I won't go into that again, but you're going to need clean, consistent baseload power, and that's nuclear. Right? So if you think about that and then you start to look at what's happened since then, you're looking at new baseload power being brought on in the U.S. with Vogtle 3 and 4, and you're seeing regulations start to clear the way in the U.S. in order to bring on more reactors. I also want to emphasize that Ontario is a leader globally in nuclear energy. And so we take advantage of it here in Ontario. It is a wonderful, clean source of energy, and it will have to be integrated into the system in order to meet the needs that we're going to have. So it's crisis necessity change. We don't want nuclear, it's dangerous, whatever, blah, blah, blah. Oh, wait, we need a lot of clean electrons. Okay, so now we have to do it, and you're seeing U.S. policy change, you're seeing regulations in the U.S. change, you're seeing actual reactors get extended in life and new reactors brought on. All of that bodes well for the miners who supply the actual uranium and the underlying, and that yellow cake, they call it, is in very tight supply. And
you have held it throughout? Did you ride the wave?
Yeah.
Okay.
And I think it's as relevant today. I think all three of these picks are as relevant today as they were back in October.
Got it. Okay, let's get to your next past pick. Global X Canadian Oil and Gas Equity Covered Call ETF, ENCC, 11.34 at the time, down to 10.74 today, 5% drop return, but 6% upside. And same thing, right? Oil's been beaten up at the start of the year, hasn't done a full recovery yet. Have you held on to this one?
Yes, I think, and this is one worth continuing to hold. The nice thing on the covered writing side of this is that we do have a concerted effort to bring on more supply of oil and gas in order to meet the energy needs. And I hope Canada gets out of the way of its carbon embarrassment and really can jump on board with this. So I don't expect huge price increases in oil. In fact, if we did get that, then that would kind of it would question how much we can grow, because that's also a tax on the economy. So I think we're gonna drill and pump a lot of these types of hydrocarbons. And the nice thing is they have nice high volatility, and that higher volatility breeds very nice covered call income for the portfolio. So I think moderately bullish, nice covered writing here, and you'll get that income. And the covered writing also kind of helps mitigate some of the up and down.
Okay, let's get to your third pick from October of last year. Invesco S&P 500 equal weight index at 78 at the time to 39.42, so 4% upside, 5% total return. Tell me about this one.
Well, this is basically taking the S&P 500, and rather than market cap weighting it, we equal cap weight it. So all 500 stocks get equal contribution to the S&P 500's return. And again, the thesis was the same, but early. And I think this is extremely relevant today. We are going to be in a time frame where now the other 493 companies are going to be able to start to contribute to performance. And we can see that chart there. It looks like it's on the verge of a breakout. If we move from this idea of we're worried about inflation, the Fed's worried about inflation. No. Now it's more worried about employment. And if we get that easing Fed combined with the PMI numbers, those economic numbers looking like they're picking up, what we've had is kind of an industrial recession, but we've had a software boom. And so now if we get this lower rates, worried about employment, now we get small caps and a broadening of the market, and now you're going to get those other 493 stocks starting to outperform those 7 software-dominated names potentially. And that's what you want to prepare for, and that's what that's there for.
Okay, we're going to take a quick break. Mike Philbrick, Resolve Asset Management, taking your questions on exchange-traded funds. Here's how to reach us. And we are back in just a moment with your phone calls. Welcome back to Market Call. We are going to the phone lines. Tony has been holding on the line. He's in Calgary. Hi, Tony.
Hi, thanks for taking my call. I'd like to ask Phil about the high-interest cash management area with this crazy market. It seems like everybody's out over their skis. What do you think about just parking some money in purpose cash management? Thanks.
Okay, so this is MNY.
Right.
But tell us about it.
So it's the Purpose Cash Money Management Fund is just a money market fund.
Okay.
So it's going to be in very short duration treasury assets, corporate, very, very AAA grade stuff. So it's a great place to hide. And if you think that if everybody's out over their skis, then yes, that's a place to put a little bit of money and earn 2-point-some%. Here's the challenge, that we just had a GDP number that was weak. That tends to mean that that rate that's on that is going to go lower because we're going to see more easing. So those are very short-term interest rate related. And if we think about that, in the US, there's $7 trillion of those types of funds on the sidelines, the most ever. And if we get easing out of the Fed as well, that money starts to look at the yield it's getting and starts to think about, well, either I'm going to increase my duration, i.e. go out to 4 and 5 and 6 and 7 years in order to keep my income up, or I'm going to start chasing risk assets. So I would take issue with the market is over its skis. I don't think that's the case. I think this is probably the most hated market rally in history, yet it continues, and you have massive tailwinds through things like AI, digital assets, the build out for those things. But that being said, that's my thoughts at the moment, not yours. And if you're thinking that we're out over our skis, then money market is a great place to park some cash and wait for opportunities, because corrections do come even in bull markets.
Okay, let's go to an email from Martin. I'm looking for a high yield long-term hold, so 5 years plus. And I'm wondering if HMAX, HMAX provides a relatively safe and stable way to achieve a 13+ return. Your thoughts appreciated. So 13+ return, is there a safe way to get to 13+?
No.
Please share if there is.
No. So the HMAX is the Hamilton Canadian Financials Yield Maximizer ETF. And, this is, again, one of the products that it's on the Canadian Financials Index. So it's your banks and your insurance companies and your mutual fund companies and so on. And it's writing covered calls on those assets. So you are exposed to the market. You are exposed to the market risk. And so, I would not anticipate it as being a safe, you'd have to define safe for me, way to make 13%. No. But, it is what it is. It's financials. Financials should do well if what we're thinking is going to happen happens, and we get a little bit more robust growth out of the U.S. and then subsequently to Canada, and that's a resource-based growth. That's even more important for the Canadian side, and the financials will participate along with that mightily. And so, am I bullish on that area? Yeah, there's real estate issues in Canada, and there's stuff we have to deal with as well. But on total mass, I think it's probably more bullish than bearish. But is it safe like the previous caller's discussion of the Purpose Money Market Fund? No, it's not quite that safe. And 13% is telling you something.
Okay, let's go to the phone lines. Chetan is on the line in Toronto. Hi, what's your question today?
EQT. What is Mike's long-term outlook, and is it a good entry point? My follow-up question is regarding the education. Like, when you're holding this kind of stuff, the distribution considered as a foreign income, and asset would be also considered as a foreign asset. Thank you.
Okay, thank you. So XEQT, which is the iShares Core Equity.
Okay, I didn't get that when he said that. So it was, I see. So iShares Core Equity Asset Allocation Portfolio. So this is an all equity portfolio, and it is going to be looking at a broad array of assets. And I think the question was,
is it a good entry point? Was part of that, as well as sort of, I guess, how it gets treated?
Yeah, from a tax perspective,
yes.
I kind of think it's okay in that this is a Canadian listed ETF. So now, if it's got, there's tax implications for all things that have global assets in them. And you do have some tax issues there with withholding of foreign dividends and things like that. but it's not it's not the end of the world, and it's pretty common. So if you're going to go global, this is going to happen no matter where you are. As for a good entry point, we have to take a look at the chart. I would imagine it's going to be a great entry point, though. Just what was it?
XEQT.
QT. Yeah, well, I mean, you're going to feel like this is overbought, and you're going to feel like, oh my gosh, it's up, sort of 20%.
What do you have it at? I don't have it up here. So what do you have it at?
I have it. I just looked at the performance line, but I have the prices at $37. It started about a year ago at $32.
Got it.
Had the correction Liberation Day, Liberation Day tariff tantrum. But again, it's focused on it's core equity, but it's got all of the equity sleeves in it. So you are diversified across the U.S. and globally, and I think that's where you want to be. And I don't think I think pullbacks are going to be muted. So if you're waiting with cash on the sidelines to invest, it's better to invest it now. If it's for long-term proceeds, like someone's going to school or someone mentioned some sort of education funding, then again, yes, now is the time.
Okay, let's go to one more email before we take a break from Gary. Hi, I'm looking for a slightly riskier fixed income ETF. I'm looking at the TD Active Global Income ETF. What would be part of the Active Global Income by TD?
The first thing is that it is global in nature, which is kind of unique. A lot of times you're thinking about bond sleeves in the portfolio as in Canadian dollars, because Canadian dollars is where your Canadian assets are, or US dollars, because those are those things that offset your US portfolio. So bonds tend to do well when we have a growth shock. So there's something going wrong in equities. Well, bonds tend to do well in certain regimes. Now that is changing a little bit when you get a little more inflation ticking in. Sometimes, like we experienced in 2022, bonds can do a little bit, can be correlated to stocks. But here's the thing about going global. If we look at those other currencies in the world, they're doing really well. And a lot of what happens with respect to your global bond portfolio is a lot of the returns are driven by the currency. Now, if you were in the US, it would be even better, because the US dollar is going through a administrative directed weakening, right? So the U.S. Fed and the administration wants a weaker dollar. So global bonds are doing really, really well in U.S. dollar terms. Not as well in Canadian dollar terms, because Canadian dollar is also strengthened against the U.S. dollar. So, but I do think it adds a great layer of diversification. It adds other global geographical regions with respect to their currency and their bond markets. So I think it's a good play.
All right, we do have to leave this block here. We're going to be back with Mike Philbrick. Resolve Asset Management is taking your ETF questions today. Here's how to reach us. Back in a moment. Welcome back. Rob's on the line today in Thunder Bay, Ontario. Hi, Rob.
Hi. I'm just wondering what your guest thinks about the ETF SPLG. I'll hang up and listen. Thank you so much.
Thank you for the question. So this is mimics the performance, I guess, of the S&P. Mm-hmm. Is it one you like?
Yeah, I mean, it's got a fee of 2 basis points. So when you're talking about cheap and cheerful exposure to the market cap weighted S&P 500, that's going to be a winner, I think. Yeah, and so. But remember, and I think it's actually an absolutely great choice. It ranks right up there with Vanguard. It's actually 1 basis point cheaper. So if that's what you're looking for, that's a great selection. Keep in mind what we've been talking about today, though, that we do think that maybe there's a broadening out coming. So maybe pair that with a little bit of the equal weight that we talked about in the past picks section, so that you have some market cap and some equal weight, something a little bit more broad, something that's a little less software technology oriented and has a little bit more of the other parts of the market. Maybe look out for the top picks as well, because there's a complementary one in there.
Okay, Rob, I hope that helps you out. Let's go to Alan on the line in Calgary. Hi, Alan.
Hi. Yeah, thanks for taking my call. Just wondering what you think of the utility space going forward with a drop in interest rates potentially, if that's going to help that space out, and what you would think of getting into a covered call like HMAX or in a non-covered call ETF for utilities.
Okay, so we haven't really talked about utility sectors. Where are you landing on utilities right now?
Well, in Canada, they're a little bit more typical. It's more of it's utilities or utilities. In the U.S., there's been a portion of the utilities market that's actually become a little bit more growthy and is acting a little bit more like an AI play. And so we've got this dual personality. But I think in Canada, as you say, these are sort of really long duration bonds. The way utilities work and the way their pricing works and how the regulations work is that they're very stable and steady in their payouts, and those are somewhat determined. So that's a good thing if you're looking for that sort of steadiness. And as you say, if we get rates decreasing, and it's long-term rates, not short-term rates, that impact the utility pricing. So we're looking for long-term rates to come down. I think there's a possibility of that. And then the covered writing, here's the funny thing with the utilities on the covered writing side, is because they're so low volatility, they tend to actually not offer huge premiums on the call side. So when you sell the call, you don't get a lot of money for it. They're not very volatile. So, but it's there. I mean, it's still the same sort of scenario. It's just not quite as fruitful as, let's say, on the oil and gas sector. That's fine. I think, as you've already stated, why don't you buy a little bit of each? Make sure you're keeping some of the upside on one side and make sure that on the other side you're enhancing your income. And that kind of meets in the middle and gives you the best of both worlds. And so I do like the sector. I think it will perform well. It's not going to shoot the lights out, but that's okay. That's not what you're looking for it to do.
Okay, Alan, I hope that answers your question as we move on to another email. This one, we have another caller. Andy is on the line. Hi, Andy.
Hi, how are you today?
Good, thanks. How are you?
Good, thank you. Mike, thanks for providing all your insights, and your optimism related to the Canadian market is reassuring for sure. My question is related to emerging markets. I have one fund, it's the Wisdom Tree Emerging Markets Multi-Factor, EMMF. Anyway, I just wanted to get your kind of high-level look at emerging markets at the current time. Thank you.
Thank you for the question. Are there lots to choose from? Is there one emerging market you like over others?
There is a ton to choose from emerging markets, and I think it is actually one of the places you should be focused on. And if I were to have another top pick, I would say something in the emerging market space is an exceptional place to be looking. So if we think about the Wisdom Tree one that you have, it's multi-factor. So here we have, remember we had that conversation about the dividend fund, high dividend versus quality, and having multiple factors. So this is what Wisdom Tree is doing. Looking at multiple factors in selecting the securities and trying to get a higher quality basket of securities. So I really like that as an opportunity, as a diversifier in your EM portfolio. Why EM? Why it was so good? Well, as we've stated, it has been a stated objective of the U.S. administration to weaken the U.S. dollar. They said that at the beginning of the year. The U.S. dollar had the weakest 6-month period, first 6 months of this year, since the 70s. That is tremendously beneficial for emerging markets, for their currencies and for their stock markets. So yes, this is a place that you should have some look. So maybe look at India as a complement as well if you want to get a little bit more focused. India is very interesting. XID is one there. And Argentina is interesting, although it's suffered a little bit, but it's going through a huge transformation. So AGHT is the ticker there. Have a look at that. Huge transformation going on in Argentina with what Milei is doing to that economy, to that currency. And I think that is extraordinarily bullish for the longer term, but it just depends on how narrow you want to go. Staying broad here is fine too.
Is there an ETF, I guess, that does multiple emerging markets, or are they all very central to one or the other?
Yeah, you can do, so you've got China as well. And by the way, China's a great one. China's on absolute fuego. So, China is something that you want to think about. Now, are they in emerging markets still or not? It's a pretty big economy, not sure. But everything. So you've got Brazil, and then you've got all of Latin America. You've got Asia, or individual Asian markets, and you've got then a basket, I think GMF is the ticker, it's all of Asia. So you pick your poison. So the ETF world is growing. And I read something the other day, was kind of funny. They said now that there's more ETFs than there are stocks, which is not surprising, right? There's more meals than there are ingredients. That's not surprising. The funny thing about that is I remember when that exact same headline was on in the 90s, and it was there are more mutual funds than there are stocks. So everything that's old is new again.
Yeah, mix and match. All right, we are going to take a quick break. Mike has new top picks. We'll share those when we come back. Join us Tuesday on Market Call. Barry Schwartz on the show. He's President CIO, Baskin Wealth Management. He'll take your questions on North American large caps. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new top picks from Mike. We're going to start with iShares Silver Bullion ETF. Silver's been doing well. Many are talking about how it usually follows gold, and we've had that gold run up. Is this one you like moving forward? Are you going to stay sort of invested in the silver sector?
Yeah, I think it is the base metal of electrification, not the precious metal of electrification. So we've got a couple of things, a couple of vectors of wind in our sail. I'm going to steal Tom Lee's granny shots. You've got a hard asset diversifier. So precious metal has some aspects that are like gold. It has got to catch up to gold. Gold has leaped forward. But you've also got this really significant tailwind from industrialization. And silver's used in a lot of methods of electrification. Right? So you've got a couple of different things going on here. And I actually think I would slant to SVR.C. So I know I put SVR in there, but let's .C it and let's hedge the Canadian, or let's not hedge the Canadian dollar, because we want to see that difference in the currency. So that would give us an advantage, give us a little extra returns of watching the US dollar get denominated a little bit more, or go down a little bit more. So I think that it's got some great opportunities in it. It's a nice satellite to your gold position. It's got that precious metals, and AI isn't just code; it's kilowatts and silver. You got to get the energy and the power and all of those AI data centers and the power distribution that goes with them and the batteries that comes along with that are all going to be consuming silver. That's why the chart looks so good, and it could really run.
Okay, let's go to your next topic. 3IQ Solana staking ETF. What is staking, first of all?
Yeah, and this is edgy. So I grant you that this is a bit of an edgy call here, but what we're entering into is the digital space. So Bitcoin, Ethereum, and Solana is sort of like a version of Ethereum. So it's a proof of stake sort of scenario. So when you're confirming transactions that are happening on the blockchain, you need to stake some of your assets in order to guarantee those. And in that staking, you make some rewards from that. And so that's kind of a Cole's notes on what staking is. But as we look at what's happened in the US and the coordinated effort to make, again, if you can't own the currency, own the protocol. If we look at Ethereum being the base of all of the stable coins and the US Genius Act sort of clarifying all the rules and all the regulations and the SEC clarifying all those rules as well, there's a coordinated effort to make these technologies very useful for financial institutions and for the tracking of all the stuff we have, the digitization of all the bonds and stocks and buildings and so on. And Solana is just one of those little bit faster, little bit newer sort of layer 2 type technologies for that. So I know this is edgy. I know it might not be for everybody. So keep it small. But in this case, the management fee is 0 for another 6 months. Okay. And you're front running the US. The US has some of these launched or listed, but they're not the actual coins. They're usually using futures or derivatives. Okay. And they're not allowed to stake yet in the US. They can't do this staking mechanism that we're talking about where Solana, this SOLQ, the 3IQ version, can. And so, again, somewhat volatile, but listen, as they build out those rails for commerce on the digital platform, the traffic follows, and as the traffic follows, these assets could do very, very well. So you only need a little to go a long way. A little bit of salt makes the meal so much better.
Okay, let's move to your next top pick then. iShares US Small Cap Index ETF, XSU. Which is obviously small cap in the U.S., but why are you moving in the small cap direction?
Because of that thesis we talked about earlier, in that if we're going to have an accommodative Fed that's more worried about employment than they are inflation, and we're going to run this economy a little bit hot for a while, understanding that tariffs are more of a one-time issue than a persistent inflationary issue, then what's going to happen is we're going to have a broadening of the market. Those other 493 stocks are going to start doing well, and you're seeing it in the stock charts of the Russell 2000. So I think we've been in a bit of a rolling recession from the industrial perspective. If we look at those small companies, you look at their earnings growth have been a yawn, but that's changing. And as the facts change, you got to change your mind. And so that's happening. And as we get that run it hot, build out this infrastructure, you're going to have a pervasive growth and a spreading of this. And those PMI numbers are starting to give us insights into that. We're already actually seeing some real economic growth under the surface. And if you layer on accommodative rates on top of that, these areas of the market can outperform those market cap.
Let me ask you about holdings in this, because clearly we had the disclosure up and you're not invested. Are you invested in something similar to this at all?
Well, we trade futures. So we are trading futures contracts that track small cap indices. So we trade a lot of the asset classes. We don't always invest in the ETFs themselves. But again, this is along the same lines as why getting into emerging markets works, why getting into Canada works, why getting into these other nations works, because the US has dominated the global equity pie, and software, if within that, is dominated. But now we have to fulfill the physical component of all of that build out. And that's where small caps come in. That's where emerging markets comes in. That's where Canada comes in.
Got it. Mike, thanks for coming in. Good to see you. Have a good weekend.
Pleasure. Thank you. And be bullish.
Oh, we will. Thanks for joining us today on Market Call. We'll see you again on Tuesday. Monday's a holiday. We'll see you then. Have a good weekend.